Hey everyone, welcome to another exciting dividend stock investing video. I have a very special guest with me on the show today.
Hi, I'm Nicole Lopuck, Ian's wife.
Nicole, welcome to the show. I have Nicole on the show today to share a very special secret dividend stock that she has owned since 2012. One of the main reasons that Nicole operates her own secret dividend stock portfolio, this is aside from the dividend stock portfolio, the 50 stocks or so that I share on my channel day in and day out, is because of Peter Lynch. I've discussed this book on the channel before, and one of Peter Lynch's thoughts that he shares is couples need to look at stock investing collaboratively because each member of the team has great ideas. And oftentimes the husband will ignore the wife's best ideas. Well, I'm here to say that Nicole has brought some of the best ideas to our overall family's investing strategy, and she's going to share a stock on the channel today that she's owned since 2012, and that particular stock is up almost 5x. For every $1 that she invested in this particular company, that $1 is now worth $4.87. And even better, because this is a channel about cash flow, she is yielding over 7% dividend yield on cost, true yield on cost on that investment.
Can anybody guess why I'm wearing red? It's for my favorite company, Target, affectionately known by many as Target. So everybody today, get ready for an exciting dividend investing video.
Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, welcome to the video. In terms of a quick agenda, Nicole is going to answer some questions right now about her investment in Target. And then in some of the later segments in the video today, I'm going to do a Target stock analysis. I'm going to go through the financial performance of Nicole's position. And then I'm also going to go through Target's annual report. So I want to get started with the questions for Nicole. Nicole, how did you come to own this stock in Target?
Well, as a family, as you can imagine, we talk about stocks a lot. I don't think there's been a day that's gone by that Ian hasn't talked about stocks in some capacity. But really what we were talking about is that I didn't own any individual stocks aside from the companies that I had worked for and I had stock in. And I kind of felt bad about that because over the years I had a number of ideas of different stocks I wanted to invest in. And for one reason or other, I didn't make those investments. I didn't really know how to make the investments, and so I never did it. And that could maybe be a topic for another video of all the money we lost out on not making some of these investments. But we were talking seriously about what stock I should invest in. And a lot of the stocks that Ian owns personally in his portfolio, have performed well, but I don't have, that sort of affinity for or passion for, and some of them, quite honestly, I don't care for their business practices. It works for him. It's not something I would want to invest my money in. So I came up with a short list of companies that I liked. And on that list was Target and Costco. And at that point, I said, I really like both of these companies. And Ian said, are you sure you want these companies? Because we already have, stock in Walmart and a large position in Walmart, and it's doing well. And I don't want to over-index on, retail. And I said, no, these are the companies I want to invest in. They're both solid companies. They're not going anywhere. And so then at that point, Ian did some analysis on both of the stocks, and he said, let's go with Target. So I was happy with that decision, and we have owned that stock ever since.
So what Nicole just said, in my opinion, is really important. And I want to underscore something for all of the couples who are watching, all of the families who are watching at home. When you're a family, generally speaking, all the money, it's shared. It's the shared money. That being said, it's really important to have each member of the team have control over buying and selling stocks, because when I manage the portfolio for our family, as Nicole mentioned, I'm kind of stuck in my ways and I have a very particular way of doing things. But because of my particular way of doing things, sometimes we've missed out on some really phenomenal opportunities that Nicole has brought to the table. And so this kind of triggered my memory at the time of Peter Lynch's book, and why it's so important, he says, to really evaluate the knowledge that all members of the team bring to the table. And one of the hacks that we've found that works really well for our family is having both of us involved in managing kind of our like own portfolios, even though it's all the same money. Just having that practice, that methodology, it makes sure that we don't miss out on really good investment opportunities like Target, which is something I probably would have never bought if I was the one just 100% managing all of the portfolio. And so I have another question that I want to ask Nicole in the video today. And why do you like Target stock so much?
Yeah, I wouldn't say I like Target stock so much. I would say I love Target and I'm happy to be a shareholder because I believe in the company. When you go into Target, it's a gratifying experience. So most of our grocery shopping I do at Target and Costco. I don't enjoy going to grocery stores. It's an okay experience. It's like, I'd say it's neutral. I don't mind going, but I don't enjoy going. However, if I go grocery shopping at Target, I can get other things that I need as well. And it's just overall, it's kind of like the unknown. You don't know what you're going to find, what seasonal decorations are going to be there, what clothes for the kids, what are like fun little games or crafts or things like that. And it's a relaxing place to go. Yeah. Well,
that's a great answer. And so, since you've bought Target stock, Nicole, and I'm going to get into the analysis later, but I remember she originally started buying like in the high $50 range back in 2012. And between 2012 and 2017, the stock went up, but then it went back down. But it was really around 2017 that it started building a lot of momentum. And then when 2019 came around, 20 and 21, this stock has just flourished, and it's been one of the best performing investments in our family, thanks to Nicole. And my question is, Nicole, why do you think this stock has gone up so much?
Yeah, I think with Target, they've faced a few kind of like PR kind of issues. And when those have come about, people go, I'm not going to Target anymore. And it's like, okay, 3 or 4 months later, are you sticking behind that conviction? And with what the numbers show, is probably not. They've had a couple of snafus over the years, but why the stock started to really change is they started really improving a lot of things that they've done as a business and also disrupting a lot of other businesses, which we'll talk about specifically. But one thing I really love about Target is this, the red card. Okay, so every time I go to Target, I save 5%. So sales tax here is over 9%, but I mean, that's a good chunk of money to save every single time. It doesn't matter if I shop in Hawaii at Target, which I have, and the sales tax is lower. I save 5% on every single purchase. So if something is the same price at Target or Amazon, where am I going to buy it from? I'm going to buy it from Target, and I'm there anyways. Also, Target does things where they do things one day a year where you can buy gift certificates up to $500 for 5% off. And that's on top of the 5% off you have on your red card. So like I get all of the teacher gifts because I get extra money that way. And you could just spend those gift cards yourself if you wanted to as well, but the money goes further. So that's one thing I'd say is really strong about Target is their red card, and a lot of people have it, especially if you're making a lot of purchases there. I mean, Target, you can get your bread and butter things like detergent. I've been shopping at Target with my parents since I was a kid. And when I was a kid, that's kind of what you went to Target for, was detergent and things like that, or like basics like underwear or things like that. But they didn't have such a great selection of clothes. And the cachet, or kind of the attitude around Target, was kind of like, oh, you're shopping at Target, are you poor, do you not have money? That was sort of like early 90s. I still liked it and we still shopped there, but it didn't have this kind of like aura to it of like, this is a cool store. But over the years, Target, beyond the red card, has done a lot of things. They have a lot of proprietary brands like Cat and Jack for kids clothes. And I'll show you some of the things. Like if you want to get matching holiday outfits for your kids, I did this at Target. Or they also have like this brand here called Cloud Island, which is a baby company brand. Another thing that Target does really well is baby products. So I think a lot of people might think, well, you can get all that stuff at Amazon. Why would someone go to Target? Well, actually you can't. So certain brands of diapers, they do not carry on Amazon, or if they do, the cost is like 2x what it is at Target. And if you have the red card from Target, you also get free shipping. So you don't have to spend the $35 minimum like you would if you didn't have the red card. First of all, diapers cost more than $35, but other baby products, like for example, the Honest Company shampoo, they used to only carry Honest Company at Target. That's a great way to bring in families as well. So what other things have happened since 2017, really, besides the credit card, these great brands? Another thing that's really improved is the app, especially even like since COVID, since 2020, things have gotten better. So I started buying online from Target a few years ago, but really since 2020, when there was inventory issues at stores and things like that, I've started using the app and making purchases, quite often, many times a month. But on the app, when I was buying things like in 2020, beginning of the pandemic, I'd order 10 things. It would come in 7 packages. And as a shareholder, I'm kind of going, that's a lot of money on shipping, and it's bad for the environment, but this doesn't really make business sense, especially since like some of those things might be a $5 tank top I bought, and now you ship that separately. But what I've noticed is they've gotten better. So if I order 10 things, maybe it comes in 3 packages. Also, the app is really great because it shows you what's in stock in the stores. Another thing is, quite honestly, the prices are better a lot of times than grocery stores and Amazon. So for example, our kids really like Space Jam and fruit snacks, because what kid doesn't like fruit snacks? Well, this Space Jam box of fruit snacks I bought online. It came to our house in 2 days, and it cost, I think, $2.59. I was just at our local grocery store yesterday. This same thing cost $5.59, more than twice as much. So it's like stuff like that adds up. Also, like if you're looking at like keto foods, this is cheaper than Amazon, and you can't find it in many stores, yet Target's kind of on the cusp of trends and things like that, so you can find products. So all in all, the company continues to innovate. It continues to grow. It looks at trends in the market, and it's ahead of them. And as I said, people have an affinity for Target. I mean, I follow all kinds of different Instagram accounts that are just fan accounts of people sharing what they found at Target. And what happens when I see that on Instagram? I go, I want that. I'm either going to add it on my cart online, or I'm going to look for it the next time I'm in the store.
Those are some really great points, Nicole. Thank you for sharing that insights with the community. And I wanted to ask you another question as a follow-up to all of this. You were mentioning that Target is going ahead and disrupting certain industries. And it's interesting because Target has been around as a company for a very long time. And a lot of members of the Dividend community, they've invested in this company a long time, just like Nicole, because they've been around and increasing the dividend actually for over 25 years, I believe, as a dividend aristocrat. And I wanted to ask Nicole about this disruption, because a lot of the best companies these days that are growing at the pace of Target, they're doing something special. They're disrupting. Which industries, Nicole, is Target focused on disrupting?
Yeah, absolutely. And I think Target has been proactive about going after certain industries. And also, I think some of it is happy accidents that other companies or other industries' misfortune has benefited Target. And they've been right there, right at the moment to step up and be there where the customer wants them to be. So quickly, I just jotted down 10 different industries that Target has absolutely disrupted. One, Toys R Us.
Yeah.
I mean, a lot of people loved that company, loved that store. We had a lot of fond memories getting things for our kids there. But the reality is Toys R Us is out, Target's in. Okay, and they have a great toy selection both in stores. It's well merchandised, well stocked, easy to find things, easy to find gifts, and online as well. And they do lots of different promotions. Again, in the app, there's things like different rewards and coupons and things like that people promote online. And of course, Black Friday, they're there front and center, ready without any sort of latency to step up where Toys R Us left out. The second one is Babies R Us was part of Toys R Us. And the reality is what's really sad is a lot of baby stores have gone out. I mean, Bye Bye Baby, I don't know how well that one is doing either. And so Target is right there. I mentioned diapers, like Huggies, things like that. Also, they're there for parents with a baby registry that's very strong. And so you're getting people hooked right from the second that they have kids, and then they're falling in love with the brands that they have, like Cloud Island, which is proprietary to them. We had all of our daughter's crib bedding from there. For our son, Toys R Us was around. His bedding was from Toys R Us.
Yeah.
And guess what? It cost 3 times the amount that, that was like a $150 bedding set. And the other bedding set we had from Target was like $50. And honestly, it was as nice of quality.
Yeah.
So it's like they stepped in where Toys R Us, Babies R Us left out. And also it's a strong price point with really nice designs. So that's the second one is baby industry. The third is Payless Shoe Source. Another thing that's out and they're there. It's like, these little cowboy boots that are by Cat and Jack, I could not buy these for my daughter because they look exactly like some cowboy boots that I had. So it's like, okay, that's an easy add-on purchase. The fourth one is children's stores. Gymboree, Children's Place, Limited to Justice. Some of these stores have gone under or been absorbed by other brands, but that kind of retail space that used to exist in malls for these stores is like 1/3, 1/4 of what it used to be. And quite honestly, people go to these stores and they can't find the sizes they want for their kids. Like I showed you the matching holiday outfit. If I went to even Target, it's hard to find 2 sizes exactly that you need in the same print. I bought it online. Or now what's a trend is like holiday clothes. So, I knew Halloween was coming up. I got this for my son. I got leggings for my daughter that must have fallen on the ground. But also uniforms.
Yeah.
Like, especially what's nice about this Cat and Jack brand is it fits kids that are on the slimmer side, and it's like really nice quality with reinforced knee. You can get it on sale. So it's like a lot of kids' clothes can be purchased there. Number 5 is craft stores like NICOLE'S. Now, I think these stores are doing really well with the pandemic and stuff and more DIYers and things like that. But again, Target is right there with the trends. They have this new brand called Mondo Llama, which is basically like these like DIY, like kids, like craft kits, stickers, painting, like little holiday crafts. Same price point as other stores. And again, you're already at Target or you're already shopping online in the app. Why would I want to go to a separate store and pay separate shipping or drive somewhere else when I could just get it at Target? 6 is one that Ian was like, don't bring this up on camera, but of course I'm going to. Victoria's Secret. Okay, Victoria's Secret, when this was like a year or so ago and people were like trying to buy that stock because it was tanking, they're like, oh my gosh, this is a good buy. Ian was like, people are talking about Victoria's Secrets. And I was like, no, steer clear. It sucks. And no offense to anybody that owns it. I hope it's doing well for you and does do well. But the reality is Victoria's Secret was behind the game for a while and they lost their customers. They lost people like myself as customers, these older millennials that frankly, they didn't have the sizes they needed to keep up with the current, size of Americans. And they weren't inclusive to things like breastfeeding and things like that. Well, you don't sell products that fit people or work for people's lifestyles. They're going to go elsewhere. And guess what? Target also has brands of lingerie that are nice quality and affordable, and they can buy it online and not have to go to a separate store, and it fits. They have size charts. And so even if Victoria's Secret has now pivoted maybe and has some sizes and things like that, it's kind of like too late. You missed the boat and people have moved on. Another one is the dollar spot in Target. Like for our wedding, I got a lot of like the placeholder things, the table decorations and things like that at the dollar spot. And I love the dollar spot. It's like my happy place, and it's a lot of people's happy places. And that's what people are posting on Instagram is, hey, I got this, and then I did this craft, and I repurposed this, and I made this cool centerpiece for my house. So things that they sell in the dollar spot are things like this. Like these little mess-free coloring books, which I like to give our kids on like car trips or at restaurants. $3 is worth like not having a meal ruined over kids like being upset. It's like, hey, I'd rather spend $3 than $3 and actually enjoy this meal. And the kids like the idea of like having something new to open, even if it's $1 or $3, that doesn't matter to them. The eighth industry that I think they've really disrupted is fast fashion. So I mentioned when I was a kid, it was kind of like, oh, are you poor? You shop at Target. Like I was middle class, I shopped at Target. But now it's kind of across the spectrum. People shop at Target, and I think it's part of it is because people are now going towards these fast fashion brands. And an alternative to H&M or Zara or some of these brands is Target. They have very stylish things. Also, what they're really quick to do is sort of like brands like Free People, where you can pay $110 for a pair of Free People leggings, or you could pay $30 for a similar design at Target. And so like these Instagram influencers had these oversized quilted jackets. Well, Target came out with their version and they sold out immediately. So not everyone can afford the Free People jacket, and not everyone wants to spend that kind of money, especially since trends change so frequently. So they're right there at the moment with brands, with designer collaborations, with styles that people like. The ninth reason is grocery stores like Safeway or Albertsons. I can't even tell you the last time I went to a store like that because, I can get everything at that I want at Target. It's most times a better price point. They have the brands I like. And so really you don't need to go to those grocery stores unless you like it or it's closer to your house. And the 10th reason I quickly came up with is maternity stores. So again, when we had our son, when I was pregnant with him, there was a motherhood maternity store at our mall. It was pretty pricey. It was expensive, but I could see the clothes, feel the fabric, try them on because maternity clothes don't fit like normal clothes do all the time. That's out of business. Maybe some locations are still there, but it's very, very difficult to find any maternity stores with clothing in person. Old Navy carries maternity online only. Well, what if I just want a sweater or I want to see what size it looks like or try it on? Target has their own brands of maternity clothes, which are cheap, like they're affordable, but they're great quality and they're stylish. And like, why wouldn't you want to do that? Again, you're there, you're getting your detergent on sale, you're getting your kids' fruit snacks, you're getting your maternity clothes, you're getting toys, like everything is there. So really, those are just 10 industries I came up with that they've disrupted, but there's probably more that I haven't even thought of.
And these are really interesting points that Nicole's bringing up because it all also ties into this modern lifestyle of convenience. These days in 2021, we're all so busy. And so isn't it nice that there's one store that is kind of a one-stop shop for all of these different needs in one place? And something else that resonated with me when Nicole was speaking here is just this notion that not only has Target disrupted certain industries, but they've also anticipated change. And they've anticipated it quickly because I remember when Toys R Us went out of business and it was all over the headlines, and it was not far from the Christmas holiday shopping season, if I recall correctly. And I remember that Target really stepped up to the plate quickly. They were able to mobilize quickly. They were able to fill a need that society had right away. And so it's interesting that they are not only visionary in terms of seeing these trends, but they're stepping up to the plate quickly. And something else that resonated with me is just as an investor, there's different types of strengths that different people bring to the table. And one of the things I would say that Nicole brings to our family that is a bit different than what I do is she's really good at spotting trends. And so if you're at home watching the video and you might just want to understand, like, out of your family, like, who's really good at the numbers, who's really good at running calculations, but who's also really good at spotting trends, because Nicole was able to see really early on that Target, way back in 2012, is a company that she said breaking the rules and disrupting and going in the right direction. And so she was able to spot that trend. But now, obviously, we're in 2021. And the big question I have for Nicole is it still a good investment right now in 2021? It's trading around a PE of 18 right now. I'm going to get to that later in the video. But it seems like it's not overvalued to me. It's not undervalued. It's kind of a fair value. But just looking at Target going forward, is this a company that's still doing exciting things? Nicole, do you think it's still an interesting stock here?
Absolutely. If I didn't own any Target stock and I was to pick a stock to invest in today, Target would be one of my front runners. Now, do I think it's going to go up at the rate in which it has in the past? I don't know, but I think at a minimum, it would hold solid and keep up with the rate of inflation. It's a solid company. It pays a dividend. And as I said, people have an affinity for it. Like, our daughter, 3 years old, over the summer, I said, do you want to go to a playground today? Or what do you want to do? And she said, I go Target. And I said, what? She wanted to go to Target because she likes the dollar spot and getting different coloring books, and she enjoys it. I mean, she takes after me. She likes shopping. But the point is, you're raising kids in the same way Starbucks does, and the way that kids love to go to Starbucks and get things there. You're raising kids that like a store, and they're going to grow up shopping there. And the reality is, money is tight for a lot of people. And quite honestly, why would anyone want to, waste money or spend money if they don't have to? I mean, even things like my nails. These are press-on nails, $7 from Target. I could go to a nail salon and take, 2 hours out of my day between driving there and sitting there and pay $45, or I could do it myself for $7. And I think the reality is more and more people are trying to save money. Yeah. They're trying to do things themselves. They like the convenience. And Target is a really solid alternative to their competitors.
I think that's a really good point that Nicole brought up about Target kind of helping their customer and making their customers' lives better, because Target is helping customers save time and having convenience. They're helping customers during a time when a lot of people are tight on finances, and they're providing great quality products for everyone. And so those are all really interesting points, because I believe as an investor that these companies that kind of tap into kind of the social fabric of social culture and help the people of any given generation do better and live better, those are the kind of companies that are going to benefit over the long run. And so I'm really excited about the video today, and I'm so grateful, Nicole. Thank you for taking time with the audience today here on YouTube to share your investing insights. Everyone, this is the real genius behind our stock market investing portfolio, and I basically go to Nicole with anything related to trends, or is this a good company? What do people think about this company? Because I come more from a numbers background, and so it's really exciting to have the ability to share Nicole's expertise on the internet, on YouTube, with all of you today. And I please encourage you all to smash the like button right now if you enjoyed this video so far, and put in the comments below, please go ahead and thank Nicole for her time. If you'd like to see her on the channel again, please say so in the comments below. It really means a lot. And with all of that, we're going to go to the second part of the video where I just dig into a few of the numbers behind Target. And before I go, thank you again, Nicole, for being on the video. All right, everyone, welcome to the second segment of the video today. Let's go through a Target dividend stock analysis, some financial performance metrics, and then I'll get into some lessons learned as well. So check it out on the screen right now. And what you see in front of you is the stock is currently trading at $241.31. If you look at the analyst estimates on earnings this year of $12.98, next year of $12.91, it's trading at a PE right now of 2018. And so 18.59 this year, 18.69 next year. I would say it's not overvalued, but it's not undervalued either. I think it's fairly valued. Now, in terms of the dividend per quarter, it's 90 cents or $3.60 a year. That places the starting dividend yield at a low amount. It's only a 1.49% starting dividend yield right now. That being said, if I take 360 and I divide it by 1298, that payout ratio is only 27.7%, so there's a lot of room to grow the dividend. And if you look at the compound annual growth rate of the dividend for the last 5 years, they're growing the dividend on average by 8.4% per year. And so this is one of those stocks. It doesn't have a really high starting yield. It doesn't have a huge yield that's going to pay for a lot of bills overnight, but they've been growing the dividend. They have a lot of room to grow the dividend. I'm going to get into some financial metrics. The company is performing well. And so for someone with a really long-term time horizon, there's a lot of opportunity for yield on cost here. Now, the market cap is 117 billion. And so I want to go through some statistics on the screen right now regarding my wife's position in this company. And so she started buying it in late 2012 at $58.99. The cheapest tranche was actually in 2014 at $57.15. And so one of the things I just want to show on the right-hand side column is you can see her average purchase price per year, and this includes net new capital deployed and also dividends reinvested. And keep in mind that most of the capital deployed was in the earlier years, although dividends have been reinvested all of these years. And you can see in 2012 the average purchase price was $58.99. It was just that starting position that I just mentioned. The average purchase price in 2013 was $66.25, so it's going up. 2014, up back down to $60.69. 2015, what a year. It's way up at $77.46. 2016, still up there at $73.55. 2017, it goes all the way back down to $58.25. And so if you compare 2017 versus 2012, over the course of all of those years, the stock didn't really go anywhere, at least according to these average purchase prices. And this is something important to keep in mind with dividend stock investing, is the stocks can fluctuate in the short run, and over even a 5-year period or so, the stock may not go anywhere. And that's okay, because in 2018, things started picking up again. It's up to $76.44 in terms of her average purchase price. 2019, it really starts skyrocketing up to $99.20 average purchase price. 2020 average purchase price $137.82. 2021 average purchase price $219.22. And now it's all the way up at $241. And so this is something I really want to share with all of you. This was such an interesting experience with Target, because Target was one of these stocks that my wife selected back in 2012. And in those first few years, she had accumulated the stock. But then as time passed, it was one of these set it and forget it type investments. It was one of these investments that, hey, the company is going to do its thing. It's going to work out. There were some setbacks along the way. As you may remember, there was some negative PR at one point. There were things happening at the company that had it set back at certain points, and you see that in the 2017 numbers. But keeping the faith, holding on to it for the long run, holding on to a company that is going in the right direction, it shows over the decade time frame that huge things are possible, whereas over the 5-year time frame, not much was that possible, at least in terms of capital appreciation. What I would also say, though, is isn't it nice? Isn't it so nice to see that for those first 5 years, it kind of went up, but then it went back down? That gave more opportunity to accumulate shares at these lower share prices. So let's keep going. Check it out on the screen right now. One other thing I want to share with you on the screen is just the recent dividend increase. increase. This is a company that is increasing its dividend at an almost faster pace than ever before. When you look at the recent dividend increase, it's now at 90 cents per quarter. It was at 68 cents per quarter before. That's a 32.4% dividend increase. And so whereas the average dividend increase over the last 5 years is 8.4% per year on average, the last one was 32%. And so again, the starting yield may be a little bit lower at 1.49%, but boy, if they can keep up 32% dividend increases, I don't know if they can. That is amazing. You can see a stock chart there. It's up and to the right, and increasingly so in recent years, starting around 2019. And in terms of my wife's performance, the profit in terms of capital appreciation, when I look at all of the tranches and all of the money going in, is 386.85%. And that includes dividends reinvested. And all dividends are being reinvested. Now, another way of looking at that is for each $1 invested, it's now worth $4.87. And so it's almost 5Xing the money put in, just under 5X. And that is in just under 10 years. And so in addition to that, though, because the charter of our family in terms of investments isn't making 5X or huge capital appreciation, surely it feeds the ego, and it's really nice to have that. But what's even more exciting is the dividend yield on cost. If I take the current annual dividends, which is $3.60, and I divide by that first tranche of $58.99, that's a 6.1% first tranche simple yield on cost. But because I did a lot of analysis for this video, the true yield on cost, when I basically look at the dividend income per year that my wife receives now, and I divide by all the money originally put into this, the true yield on cost is 7.26%. And that is including reinvesting dividends and the free money, quote unquote, that came out of those dividends that was reinvested in there. And so that gives an accurate picture of what's possible over the long term. Over a 7% true yield on cost with target stock by holding it under a decade's amount of time, with just staying the course, buying it obviously when it was trading at lower prices than it is now, but still, even here in 2021, it's trading at a PE of 18. And so there's probably some room for this company to continue to flourish over time. But there are so many lessons that we learned from investing in this company, that my wife taught me about investing, working on this as a team, as a family. And I want to get into some of those lessons. And then I'm going to close out just with some financial metrics from Target from their annual report as well. And so in terms of lessons, check it out on the screen right now. And so some of the big lessons we learned from this is just listen to your spouse. One of the biggest things that comes out of Peter Lynch's book, One Up on Wall Street, I reviewed this book on my channel. I'll link to it in the description below, in the pinned comment below as well, is he says so many men in investing take charge of the family investments, and that's a great thing, but they kind of ignore what their spouse has to say. They don't listen. But what's so interesting about this one is I totally took Peter Lynch's advice to heart. And I think it wasn't intentionally, but I grew up reading his books, and so I think it was imprinted in my mind. And I think that the idea here that my wife has her own dividend stock portfolio, she doesn't have to listen to what I'm saying to buy this or that, but she really takes it on her own knowledge of the companies, her own knowledge of which companies are trending, which companies are going in the right direction, and just goes for it. That is a home run strategy, in my opinion, for any couple, is having both members of the team work together, and sometimes giving each member of the team, whether it's me or my wife, freedom to make decisions without the other person really saying yes or no. And so I was totally behind Target stock from the beginning, but I had no idea it would go up this much. I had no idea the yield on cost would have done so well, but I have a suspicion that my wife knew about that all along, because she's very savvy with this company and has a intimate knowledge with this type of retail company that I just don't have. And so everyone out there watching, make it a team event. Work on your investments with your spouse, with your significant other as a team, and listen to both people's ideas because they're both great. Let's keep going. Check it out on the screen right now. The next lesson that I learned was just follow trends in society. I would say my wife is better about this than I am in many respects, but she knows all the trends in retail, and the trends were and they still are in Target's favor. I would say it's all about the long term. And so this, I can't underscore this enough. This goes back to the point I just shared on the Excel spreadsheet I shared a few minutes ago. But in the first few years of Target, in those first 5 years of owning the stock, it went up a bit, but then it went all the way back to the original purchase price. And so the lesson there is it's okay to weather some volatility there in the 5-year periods, but looking 10 years out or even longer, it's all about the long term, and the long term worked out really well for this. I think this is a perfect case study of why I'm a dividend investor, why my wife's a dividend investor for long periods of time, not short periods. And so if you look at a stock, you just bought it a year ago and it's down, that doesn't really mean anything. What means something is where is it in 10 years amount of time. Let's keep going. Check it out on the screen right now. The next lesson learned is yield on cost is possible even with low starting yields. Target is a stock that has a very low starting yield right now, but as you can see over long periods of time, because of dividend growth, yield on cost is what really matters. And now we're receiving over 7% true yield on cost on Target stock. And that's what's possible with the long-term approach and with dividend growth. And this is why it's called dividend growth investing and not just dividend investing. Let's keep going. Check it out on the screen right now. Another lesson learned from all of this is dollar cost averaging works. And so low prices are your friend. And there were some years there where Target stock retreated and it went to lower prices. And even reinvesting dividends at those lower prices added great value for my wife's position in Target there over the long run. And I would say set it and forget it works for world-class companies as well. You would be surprised, but in the first few years of owning Target stock, we were looking at it a little bit more closely. And that's because net new capital was being infused in building the position in Target stock. But then there were certain years that went by where really the dividends were reinvesting, but I don't think we were looking at it too closely. Now, I'm talking about from a deep financial analysis standpoint. I think on a day-to-day basis, my wife is a consumer at Target and is intimately familiar with the company, understands what's happening at the company, the trends, follows the blogs. And so she was keeping up with Target from a macro level. And that's something that I would say is another lesson is invest in what you know. And this goes back to the Peter Lynch strategy as well. Invest in what you know. But I would say from a day-to-day financial analysis standpoint and analyzing quarterly reports, for many years there, honestly, until producing this video, that's not something I was spending much time on at all. And so that's why I am a dividend stock investor, because set it and forget it works with world-class companies. Now, I want to keep going. I want to share a few things that are really cool from Target's annual report before we close out the video today. So check it out on the screen right now. This is from Target's 2020 annual report. And what you see is their 2020 sales and how they break down by division. And so it's interesting that they're roughly broken into 5 different divisions that are reasonably of equal size, although apparel is only 16%, but beauty, household essentials are 26%, food and beverage 20%, home furnishings and decor 20%, apparel and accessories 16%, and then hard lines, I wonder what that is, 18%. I'll have to learn more about that. But this is a US-focused retail company, and this retail company is not just focused on one area of retail, but they have 5 large different buckets of retail that are reasonably evenly dispersed. And so there's some diversification there that comes with Target. Now, what I love most about this company is the financial performance. So you got to check it out on the screen right now. And what you see with the financial summary is the revenue, the sales. When you look at 2016 through 2020, it is up and to the right. It's in the right trend, although the years here are reversed. And so I guess it's up and to the left with the way it is on the screen right now. But we go from all the way up from 69 billion to 71 billion to 74 billion to 77 billion to 92 billion. And so it just keeps growing in terms of their revenue. Now, what I would also say is so interesting is it flows down to lower down on the income statement. The operating income is growing, 4.8 billion, 4.2 billion, 4.1 billion, 4.6, 6.5. So there's a little more fluctuation there on the operating income, but generally speaking, it is trending in the right direction over long periods of time. And when you look at the net earnings, all the way at the bottom of this income statement, it goes from 2.7 billion to 2.9 billion to 2.93 billion to 3.2 billion to 4.37 billion. And so it's so exciting to see is on all of these kind of income statement related metrics, you're seeing a consistent trend all the way from the top of the income statement, when you get to the mid level of the income statement on those operating results, all the way to the bottom of the income statement on the earnings. It's growing year over year over year. And this isn't just a pandemic thing, by the way. Yes, I would say the pandemic changed retail in many ways, which benefited companies like Target. But even before the pandemic, the numbers were trending in the right direction. And this is a company with a rich heritage of performance, which is one of the reasons after accumulating all those initial shares, it's a set it and forget it type investment for our family. Now, let's keep going. Check it out on the screen right now. There were some more financial metrics that were shared in the annual report, and these start getting, I would say, into financial position. And well, I guess before we even do that, let's look at just some per share metrics. You can see the net earnings per share on a diluted basis. They keep growing. $4.69, $5.29, $5.51, $6.36, $8.64. So again, you can see they're trending in the right direction. And the you can see also the cash dividends declared keep increasing, $2.36, $2.46, $2.54, $2.62, $2.70, and so in the right direction. And now we know it's even higher than $2.70 on an annualized basis. Now, as I get to the financial position, the balance sheet type of data, you can see that the assets over time are growing. And one of the things I really like about this company, I don't have it in front of me right now as I film this video, but I will share it on the screen with all of you right now. One of the things I like about this company is they own a lot of their real estate. They don't lease a lot of it. They actually own the real estate. And so they have true assets at this company. And so I really love that. And when I toggle back here and I show the balance sheet data again, you can see over time their assets are appreciating. And so they have assets that are growing at this company. I think these are real assets because they own so much real estate. Now, in terms of capital expenditures, upkeeping that real estate, it's nice to know that it's been reasonably steady. It's not been spiking too much any one year. I also like that the long-term debt, it's not growing that much over time, or it's not really growing at all. It's been very flat over time, the long-term debt. And so I think from a balance sheet position, from a stockholder's equity position, just from keeping the books really solid, I would say that Target is really great at that. Now, in terms of some financial ratios, we get into a kind of balance or an income statement ratio here, the gross margin. It has been pretty steady over time. It's down just a little bit, but not 29.2% down to 28.4%. I'll take it. And then their operating income margin is very steady, more or less, around that 7% range, although it kind of dipped into the 6% and even the 5s in some of those years. One of the things I would say about a retail business in general is margins as you get further down the income statement are lower because they're a middleman business model. They don't manufacture most of the goods they're selling. They are procuring them and then selling them out. And they have the real estate they have to manage, the employees, the overhead. That's why margins are thinner as you get further down the income statement. But I would say that 7% range for a company like this is very respectable, and I like that. Let's keep going. Check it out on the screen right now. And so what I also want to share is the shares outstanding. They've been declining over time, so they have been buying back some shares. That's okay because they have not been taking out debt to do it. How do we know that? We already know long-term debt is not growing. And so what I also would say is their revenue per square foot is increasing over time. What's so fascinating is their retail square feet. It's growing, but not that much. And their number of stores, what's so interesting is it's growing, but not that much. And so what's so fascinating about this company is they're growing really quickly, but they're not adding a ton of real estate at this point. And so they're getting more for what they have already. And they're doing really well online as well. And so that's just a few quick metrics from their annual report for Target stock. And so I would say it was fun doing this video today because one, I got to share with you why our family is so successful, and that is because of all of the value my wife brings to the table. And so I am truly blessed and lucky to have such an amazing wife, and I'm so glad she took the opportunity to share her knowledge with all of you today in that opening segment. I would say Target is one of the best stocks that our family owns. It has performed very well. And so that just speaks volumes to the collaborative team effort that we employ as a family in dividend stock investing, and also giving each member of the family freedom to make decisions as it pertains to finances. And so my wife hit a home run with Target stock, and we will continue to hold this one forever. And so let me know, everyone, in the comments below. What do you think about Target stock? Is it a stock you own? Do you think it's a buy here? Are you still buying Target stock? At this point, we're just reinvesting dividends, but let us all know. Let me know in the comments below how you pursue dividend stock investing and personal finance with your spouse. Do you make it a collaborative effort like we do? I would love to hear. What are some of your best stories in terms of capital appreciation? I would say Target is way up there on our list of capital appreciation and just home runs. So what are some of your best, and yield on cost as well? Share in the comments below. Before we head out today, everyone, please go ahead and smash that like button. I want this video to reach as many people as possible. It means the world to me. And please go ahead and subscribe. I have more videos on the way. And again, please go ahead and thank my wife, Nicole, in the comments section below for showing up on the show today, sharing her story, her expertise with Target stock. I'm so happy that we finally got to do this collaboration for the community out there. And before we leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. My wife's not a licensed investment advisor. Today's video is just for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor. First, we're just sharing our journey here on YouTube for fun and entertainment. It's possible to lose a ton of money in the stock market. Also, before we leave today, in terms of full disclosure, my wife is long Target stock, TGT. Therefore, our family, we own Target stock. All right, everyone. I love you all. I'll see you in the comments below. I'll see you in the next dividend investing video. All right, everyone, we're back. I have a bonus segment for all of you. I have one more question for Nicole that I wanted to ask in the video today, and that is about the difference between Walmart and Target. A lot of you know I own Walmart stock. We own Walmart stock. It's all part of the family portfolio. And so that being said, we own Target in addition. And so, Nicole, what do you think are some of the pros and cons, the benefits of one company versus the other?
Yeah, absolutely. So Walmart is a stock that Ian is a big fan of, big advocate of. I think he's owned it the entire time we've been together, a long time. Walmart, for me, I wouldn't want to personally invest in it because some of their business practices I'm not that much a fan of. But in terms of the shopping experience, I can only speak to shopping at Walmart stores in the Bay Area. So I think Walmart in other states might be a totally different experience. But in the Bay Area, Walmart stores, not in the best locations, kind of sketchy parking lot situations. It's kind of a get in, get out type of situation. It's, the merchandise, the last time I was there was a number of years ago, but the merchandise was messy. It was hard to find sizes. A lot of the stuff just didn't seem necessarily to be the best quality. Now, with that said, I've kind of had to eat a little bit of crow since the pandemic, and I've been buying things online from Walmart because when there was inventory issues, Walmart had pretty good inventory online, and I was happy with their online shopping experience. And I've noticed some areas in which their product offering is stronger than Amazon or Target. And those are specific types of toys. So like our son is obsessed with Beyblades. If you're a parent and your kid likes Beyblades, then you probably know what we're talking about, which is getting woken up at like 6 a.m. by these crashing tops battling each other. But they have more Beyblades at Walmart than Target. They have better selection of Hot Wheels online. They have a better selection of Paw Patrol clothing and Trolls clothing and character clothing and things like that, because that's probably something that has done really well for them. So those are the pros of Walmart. What I would say though is the shopping experience isn't a pleasant one where, at least in the Bay Area, where I would say I enjoy shopping there. I would like to shop there in the way that Target is, and the way that Target has this affinity, not just here in the Bay Area, but across the country, where people are like, hey, I have free time. I want to go to Target. I don't even have anything on my list, or I have $15 worth of things on my list and I came out $186 later. Target has this joy-inducing feeling, which I think is really important to any company. Also, their clothing is better quality. Like this Cat and Jack brand that I've talked about a few times, the leggings just hold up. And guess what? Anytime within 1 year, if it doesn't, you can return it. On the red card, you don't have to have your receipt or anything. They just look up your purchases. So having that like quality guarantee is a big deal. I think that the main differences are Target is better stocked, better selection of merchandise, better proprietary brands, overall great shopping experience. So I wouldn't really, even though they are direct competitors, and if you were to look on Yahoo Finance or Google Finance or any of these things, they are direct competitors. There is a difference in why you're going to those stores. Now, if we move to an area where Target was far away and Walmart was closer, and that Walmart was in a better area, would I go to Walmart? Sure. But I think even if you already own Walmart stock, it would be worth taking a look at Target. And conversely, if you own Target stock, it wouldn't be bad looking at Walmart, because I know that has performed really well for you over the years.
Absolutely, but not quite as good as Target. That's for
yes.
That's for sure.
The thing is, sometimes I know what I'm talking about. Sometimes I don't.
I would say most of the time, or all of the time. And so thank you so much again, Nicole, for being on the video today. And we will see you in the next dividend investing video.
Thanks.